Hey there, finance enthusiasts. Welcome back to the channel. Today, we're diving deep into the world of statutory and internal audits, and I've got a special treat for you. After creating 3 solid videos on statutory audit interview questions, it's time to spice things up with bonus interviews. We're going to tackle 50 essential questions that are not just relevant, but crucial for anyone stepping into the audit field. So grab your notepad and let's get started. These questions are crafted after compiling from lots of interview candidates from past few years. Kindly do spend a good time watching the video. You can speed up the video to adjust to your speed, take screenshots, and do not forget to help your friends. First up, let's talk about audit assertions. What are audit assertions or financial statement assertions? Well, these are the claims made by management regarding the accuracy and completeness of the financial statements. They're basically the foundation upon which the auditor bases their work. Think of them as a set of promises. Management is saying, trust us, everything is in order. The auditor's job is to test these assertions to ensure that they hold true. There are several types of assertions, and they can be categorized into 3 main types: existence, completeness, and valuation. Moving on, what are transaction level assertions? These assertions relate specifically to the transactions that have occurred during the accounting period. They help auditors determine whether transactions are recorded accurately and reflect the true nature of the business activities. Common transaction level assertions include occurrence, completeness, accuracy, and cutoff. For instance, when a sale is recorded, the auditor needs to verify that the sale actually took place, that it's included in the financial statements, and that it's recorded at the correct amount. Now let's discuss account balance assertions. These assertions focus on the balances of accounts as of the reporting date. They help auditors verify that the amounts reported in the financial statements are accurate and complete. Key account balance assertions include existence, rights and obligations, completeness, and valuation. For example, if a company reports an asset on its balance sheet, the auditor needs to confirm that the asset indeed exists and that the company has the right to it. Alright, let's switch gears and talk about materiality. What do you understand by materiality? Materiality is a fundamental concept in auditing that refers to the significance of an amount, transaction, or discrepancy in the financial statements. In simple terms, it's about determining whether a piece of information is important enough to influence the decision-making of users of the financial statements. An auditor assesses materiality based on both quantitative and qualitative factors. For instance, a small error in a large company's financials may not be material, but the same error in a small business could be significant. Speaking of materiality, what are the components of materiality? One key component is performance materiality. This is the amount set by the auditor that is less than the materiality level for the financial statements as a whole. It's used to reduce the probability that the aggregate of uncorrected and undetected misstatements exceeds the materiality level. Essentially, it acts as a safety net for auditors, ensuring they catch any potential issues before they affect the overall financial statements. Now let's dive into CARO 2020. What is the applicability of CARO 2020? CARO, or the Company's Auditor's Report Order, is a set of requirements that auditors must follow when reporting on the financial statements of certain companies. CARO 2020 applies to companies that are required to have their accounts audited under the Companies Act, and it includes specific reporting requirements that auditors must adhere to. It's an essential guideline that helps maintain transparency and accountability in financial reporting. Speaking of CARO, let's discuss the changes in CARO 2020 versus CARO 2016. What are the new clauses added in CARO 2020? The updated order includes several new clauses that enhance the auditor's reporting responsibilities. For instance, CARO 2020 introduced clauses related to the company's ability to continue as a going concern, the reporting of fraud, and the adequacy of internal financial controls. These changes reflect the evolving landscape of corporate governance and the need for auditors to provide more comprehensive insights into a company's financial health. Now let's talk about audit opinions. What are the types of audit opinions issued by the statutory auditor? There are 4 main types of audit opinions: unmodified opinion, modified opinion, adverse opinion, and disclaimer of opinion. An unmodified opinion indicates that the financial statements present a true and fair view, while a modified opinion suggests that there are issues that need to be addressed. An adverse opinion is a serious red flag, indicating that the financial statements are misleading, and a disclaimer of opinion means the auditor could not obtain sufficient evidence to form an opinion. Each of these opinions carries significant implications for the company's stakeholders. Next, let's explore the difference between special purpose audit reports and general purpose audit reports. A special purpose audit report is tailored for a specific user or purpose, such as compliance with a regulatory requirement or financial reporting for a particular project. In contrast, a general purpose audit report is designed for a wider audience, providing an overall assessment of the financial statements. It's important for auditors to understand the context and purpose of the audit to ensure that their report meets the needs of the intended users. Now, as an auditor, how will you report fraud committed in the company? Reporting fraud is a serious responsibility. If an auditor uncovers evidence of fraud, they must communicate their findings to the appropriate level of management and, in some cases, to the board of directors. If the fraud is material and affects the financial statements, the auditor must consider the implications for their audit opinion. Transparency and integrity are key here. The auditor's role is to ensure that stakeholders are aware of any fraudulent activities that could impact the company's financial health. Let's shift gears and discuss the applicability of INDAs on companies. What is the applicability of INDAs, and which schedule applies for preparing financial statements? Ind AS, or Indian Accounting Standards, are a set of accounting standards that apply to companies in India. They aim to bring consistency and transparency to financial reporting. The applicability of INDAs depends on the type of company and its financial reporting requirements. For instance, listed companies and certain unlisted companies are required to comply with INDAs. The schedule that applies for preparing financial statements is typically Schedule 3 of the Companies Act, which outlines the format and disclosures required. Now, let's talk about the cash flow statement. How is the cash flow statement structured, and can you provide examples of each activity? The cash flow statement is divided into three main sections: operating activities, investing activities, and financing activities. Operating activities include cash flows from the core business operations, such as receipts from customers and payments to suppliers. Investing activities encompass cash flows related to the acquisition and disposal of long-term assets, like purchasing equipment or selling property. Finally, financing activities involve cash flows related to the company's capital structure, such as issuing shares or repaying loans. Each of these sections provides valuable insights into the company's financial health and liquidity. Let's move on to earnings per share. What is the difference between basic EPS and diluted EPS? Basic EPS is calculated by dividing the net income available to common shareholders by the weighted average number of shares outstanding during the period. On the other hand, diluted EPS takes into account potential dilution from convertible securities, stock options, and other financial instruments that could increase the number of shares outstanding. This means that diluted EPS provides a more conservative view of a company's earnings per share, reflecting the potential impact of these dilutive securities. Now, let's discuss reportable segments as per IND as 108. What are the criteria to define a reportable segment? A reportable segment is defined based on the internal management structure of the company. To determine whether a segment is reportable, the company must assess whether it meets certain criteria, such as revenue thresholds, profit or loss assessments, and whether the segment is regularly reviewed by the company's chief operating decision maker. This helps stakeholders understand the performance and financial position of different segments of the business. Let's go with a practical question. How do you audit payroll or employee benefit expenses? Auditing payroll requires a thorough understanding of the company's payroll processes and controls. The auditor should start by reviewing the payroll policies and procedures, ensuring that they are in line with legal requirements. Then, they can perform tests of controls to verify that the payroll calculations are accurate. This might include sampling employee records, checking for proper approvals, and ensuring that deductions and benefits are correctly accounted for. Ultimately, the goal is to ensure that the payroll expenses reported in the financial statements are accurate and complete. Let's tackle a question that often comes up in interviews. How do you evaluate the risk of material misstatement in a company's financial statements? When it comes to evaluating the risk of material misstatement, it's all about understanding the company's environment and the specific risks that could impact its financial reporting. You want to start by assessing inherent risks, which are risks that exist before considering any internal controls. You'll also want to analyze control risks, which are the risks that the controls in place won't prevent or detect a material misstatement. Finally, you should consider detection risk, which is the risk that the auditor's procedures won't catch a misstatement that exists. By combining these elements and performing a thorough risk assessment, you can identify areas that may require more scrutiny during your audit. Now, what if you're in the middle of an audit and debtor confirmations aren't received? What steps will you take? Great question. If debtor confirmations aren't received, the first step is to follow up with the debtors. Sometimes a little nudge is all they need. If that doesn't work, you can consider alternative procedures. This might involve reviewing subsequent cash receipts, examining the sales agreements, or checking the client's records to see if there are any discrepancies. It's crucial to document your efforts and findings, as this will help you assess the impact on your audit opinion later on. Next, let's dive into a term that might sound a bit technical but is super important. What is a walkthrough test and control testing in an audit? A walkthrough test is essentially a process where the auditor traces a transaction from its initiation through to its recording in the financial statements. This helps the auditor understand the flow of transactions and the controls in place. Control testing, on the other hand, involves testing the effectiveness of these controls to ensure they are functioning as intended. Both of these tests are essential in evaluating the internal controls of a company and determining the overall audit strategy. Now let's talk about a crucial document in the audit process. What is a management representation letter, MRL? Why is it used and who takes it? The management representation letter is a written statement from management to the auditor confirming the accuracy of the financial statements and providing additional context about the company's operations. It's used to obtain assurances that the information provided is complete and truthful. Typically, this letter is signed by the CEO or CFO, and it serves as an important piece of evidence for the auditor informing their opinion on the financial statements. Moving on, let's discuss the disclosure requirements of Note 1 in financial statements. Note 1 often provides a summary of significant accounting policies and other relevant information that helps users understand the financial statements. This can include the basis of preparation, the accounting framework used, and any critical estimates or judgments made by management. It's essential for ensuring transparency and allowing stakeholders to make informed decisions based on the financial information presented. Now let's clear up a common confusion. What is the difference between contingent liabilities and provisions? Contingent liabilities are potential obligations that may arise depending on the outcome of a future event, like a lawsuit. They're not recognized in the financial statements, but are disclosed in the notes if they're material. Provisions, on the other hand, are liabilities of uncertain timing or amount that are recognized in the financial statements. For example, if a company knows it will have to pay a certain amount for a warranty claim, that would be recorded as a provision. The key difference lies in the certainty of the obligation and how they're treated in the financial statements. All right, let's switch gears a bit and talk about non-balance sheet items. Non-balance sheet items refer to items that don't appear on the balance sheet but can still impact a company's financial health. This can include things like operating leases, contingent liabilities, or even certain types of off-balance sheet financing. Understanding these items is crucial for a comprehensive analysis of a company's financial position. Now, many of you might be wondering about the journal entries for bad debts and provision for bad debts. When you identify a bad debt, the journal entry typically involves debiting the bad debt expense account and crediting accounts receivable. This recognizes the loss in your financial records. For the provision for bad debts, you debit the bad debt expense and credit the provision for bad debts account. This way, you're setting aside an estimate for potential future losses, which is a prudent approach to managing receivables. Next up is a big concept. What is audit risk and what are its components? inherent risk, control risk, detection risk. How are they related? Audit risk is the risk that the auditor may issue an incorrect opinion on the financial statements. It's made up of three components: inherent risk, which is the risk of material misstatement without considering internal controls; control risk, which is the risk that the internal controls won't prevent or detect misstatements; and detection risk, which is the risk that the auditor's procedures won't catch any misstatements. These components are interrelated, and understanding them helps auditors design their audit procedures effectively. Now let's get into the nitty-gritty. What are the steps to perform an audit for a client, from onboarding to reporting? The audit process typically starts with client onboarding, where you gather initial information and understand the client's business. Next, you'll conduct a risk assessment to identify areas of concern. Then comes planning, where you outline your audit strategy and procedures. After that, you perform fieldwork, which involves testing controls and substantive procedures. Finally, you wrap it up with reporting, where you communicate your findings and provide an audit opinion. Each of these steps is crucial for ensuring a thorough and effective audit. Let's shift our focus now to internal financial controls. What are they and how are they different from internal audit? Internal financial controls are processes put in place to ensure the integrity of financial reporting and compliance with laws and regulations. They help prevent errors and fraud. Internal audit, on the other hand, is an independent function that evaluates the effectiveness of these controls and assesses the overall risk management framework of the organization. While internal controls are about prevention, internal audit is about evaluation and improvement. Next, we have another important term. What is an audit program? An audit program is essentially a detailed plan that outlines the audit procedures to be performed during the audit. It provides a roadmap for the auditor, detailing the objectives, the scope of the audit, and the specific tests to be conducted. Having a well-structured audit program is essential for ensuring that the audit is thorough and that all relevant areas are covered. Now, let's talk about something every finance professional should know. What are the methods for charging depreciation under the Companies Act? Under the Companies Act, there are several methods for charging depreciation, including the straight-line method, where the same amount is charged each year, and the written-down value method, where a fixed percentage is applied to the remaining book value of the asset each year. There's also the units of production method, which charges depreciation based on the output produced by the asset. Understanding these methods is crucial for accurately reflecting the wear and tear of assets in financial statements. Now let's clarify another important distinction. What is the difference between vouching and verification? Vouching is the process of checking the authenticity of transactions recorded in the books of accounts by examining supporting documents like invoices or receipts. Verification, however, involves confirming the existence and ownership of assets and liabilities, ensuring that they are accurately reflected in the financial statements. While both processes are essential for ensuring the accuracy of financial reporting, they serve different purposes in the audit process. A question that often comes up in discussions about financial reporting: what are financial assets and equity instruments as per Ind AS 32? Under Ind AS 32, financial assets are any assets that are cash, equity instruments of another entity, or contractual rights to receive cash or another financial asset. Equity instruments, on the other hand, represent a residual interest in the assets of an entity after deducting liabilities. This includes shares and other ownership interests. Understanding these definitions is crucial for proper classification and reporting in financial statements. Next, we have: what are substantive audit procedures and analytical procedures in an audit? Well, substantive audit procedures are tests that auditors perform to gather evidence regarding the completeness, existence, and valuation of financial statement items. They can include direct tests of transactions, account balances, and disclosures. On the other hand, analytical procedures involve evaluating financial information through analysis of plausible relationships among both financial and non-financial data. Think of it as a way to spot anomalies or inconsistencies that might need further investigation. Both procedures are crucial in forming an audit opinion, so understanding how and when to apply them is key. Moving on to next question. What is a limited review? A limited review is a type of audit that provides a lower level of assurance compared to a full audit. It's typically conducted for interim financial statements, and it involves inquiries and analytical procedures rather than extensive testing of transactions. The goal is to provide a quick snapshot of the financial health of a company without going into the depth of a full audit. This is particularly useful for stakeholders who need timely information but don't require the comprehensive assurance of a full audit. Now let's talk about control testing. How do you perform control testing in an audit? Control testing is all about assessing the effectiveness of a company's internal controls. To perform control testing, you would first identify key controls relevant to the financial reporting process. Then, you test these controls to see if they're operating as intended. This might involve examining documentation, observing processes, or even reperforming certain tasks. The idea is to ensure that the controls are not only designed properly, but are also functioning effectively to mitigate risks. Next up, we have a technical question. What are the two models, cost and revaluation, under Ind AS 16 for recording PPE? Under Ind AS 16, which deals with property, plant, and equipment, there are indeed two models for recording PPE. The cost model allows you to carry assets at their historical cost, less any accumulated depreciation and impairment losses. On the flip side, the revaluation model lets you carry assets at their fair value, which is determined through periodic revaluations, less any subsequent accumulated depreciation and impairment losses. Choosing between these models can significantly impact your financial statements, so it's crucial to understand the implications of each. Now let's switch gears a bit and discuss reporting requirements. What are the reporting requirements under Clause 7 and Clause 11 of CARO 2020? Clause 7 focuses on the company's internal audit system, requiring the auditor to report whether the company has an internal audit system in place and whether it is commensurate with the size and nature of its business. Clause 11 deals with the company's compliance with laws and regulations, requiring the auditor to report on whether the company is compliant with applicable laws related to its business operations. These clauses help ensure transparency and accountability, which are vital for maintaining trust in financial reporting. Moving on, let's tackle a common concern. What are the benchmarks used for calculating materiality? Materiality is a concept that helps auditors determine the significance of misstatements in financial statements. The benchmarks for calculating materiality often include a percentage of total revenue, total assets, or equity. A commonly used rule of thumb is to set materiality at around 5% of net income or 1% of total assets. However, it's essential to consider the specific context of the company and its industry, as these factors can influence what is deemed material. Next question, what is deferred tax, and when do deferred tax assets and deferred tax liabilities arise? Deferred tax arises due to temporary differences between the carrying amount of an asset or liability in the balance sheet and its tax base. A deferred tax asset occurs when taxes paid exceed the tax expense recognized in the financial statements, often due to deductible temporary differences or loss carry forwards. Conversely, a deferred tax liability arises when the tax expense exceeds the taxes paid, usually due to taxable temporary differences. Understanding these concepts is crucial for accurate financial reporting and tax planning. Now let's talk about inventory valuation methods. What are LIFO and FIFO methods for inventory valuation? LIFO, or last in, first out, assumes that the most recently acquired inventory items are sold first. This method can be beneficial during times of rising prices as it results in lower taxable income. FIFO, or first in, first out, assumes that the oldest inventory items are sold first. This method often results in higher taxable income during inflationary periods, as the cost of goods sold reflects older, cheaper costs. Both methods have their pros and cons, and the choice between them can significantly affect financial statements and tax liabilities. Next, let's discuss reporting formats. What are the reporting formats for financial statements under Schedule 3? Schedule 3 of the Companies Act outlines the format for financial statements, including the balance sheet and statement of profit and loss. The balance sheet is presented in a vertical format, categorizing assets and liabilities into current and non-current. The statement of profit and loss can be presented either in a traditional format or a statement of profit and loss format, detailing revenues, expenses, and the resulting profit or loss. Understanding these formats is essential for compliance and clarity in financial reporting. Now let's touch on a more specific aspect of company classification. What is the latest definition of a small company? As per the Companies Act, a small company is defined as a company that meets certain criteria, such as having a paid-up share capital of not more than Rs 2 crore and a turnover of not more than Rs 20 crore. This definition is significant because small companies enjoy certain exemptions and simplified compliance requirements, making it easier for them to operate without the burdens of larger corporations. Next question, which companies are required to conduct internal audits? According to the Companies Act, internal audits are mandatory for certain classes of companies, including those with a paid-up share capital of Rs 10 crore or more, or those having a turnover of Rs 100 crore or more. Additionally, companies that are required to prepare consolidated financial statements must also conduct internal audits. Internal audits play a crucial role in ensuring the effectiveness of internal controls and compliance with laws and regulations. Now, let's dive into employee benefits. What are defined benefit plans as per Ind AS 19? Defined benefit plans are retirement plans where an employer promises a specified pension payment, lump sum, or combination thereof upon retirement, based on factors like salary history and duration of employment. Under Ind AS 19, companies must recognize the present value of defined benefit obligations and any plan assets in their financial statements. This involves complex calculations, including actuarial assumptions, to ensure accurate reporting of liabilities and expenses related to employee benefits. Next up, we have a question about internal controls. What are the components of an internal control framework? An effective internal control framework typically includes 5 components: control environment, risk assessment, control activities, information and communication, and monitoring activities. The control environment sets the tone at the top, establishing the culture of integrity and accountability. Risk assessment involves identifying and analyzing risks that could affect the achievement of objectives. Control activities are the policies and procedures that help ensure management directives are carried out. Information and communication ensure that relevant information is captured and communicated in a timely manner. Finally, monitoring activities involve ongoing evaluations of the internal control system to ensure it remains effective. Now let's wrap up with a practical scenario. What are the basic accounting control objectives for achieving effective internal controls over financial transactions? The primary objectives include ensuring the accuracy and completeness of financial transactions, safeguarding assets against loss or theft, ensuring compliance with laws and regulations, and promoting operational efficiency. To achieve these objectives, companies should implement robust internal controls, such as segregation of duties, regular reconciliations, and thorough documentation practices. These controls help mitigate risks and enhance the reliability of financial reporting. Let's consider a specific application. What internal control measures would you recommend for a park or recreational facility to manage sales and revenue? For a park or recreational facility, I'd recommend implementing a few key internal control measures. First, ensure that there's a clear segregation of duties between cash handling, record keeping, and reconciliation. This helps prevent fraud and errors. Second, establish a robust ticketing system that tracks sales in real time, providing a clear audit trail. Third, conduct regular reconciliations of cash collected against ticket sales and other revenue sources to identify discrepancies promptly. Lastly, consider implementing periodic internal audits to assess the effectiveness of these controls and make necessary improvements. Next is viewing the contracts with transportation providers to understand the agreed upon rates. Next, you'd examine invoices and compare them. How do you ensure the independence and objectivity of a statutory audit? This is a big one. Independence is the cornerstone of any audit. To ensure independence, auditors should avoid any relationships or situations that could compromise their impartiality. This means steering clear of any financial interests in the company being audited and maintaining a professional distance from management. Regular training on ethical standards and the importance of objectivity can also reinforce this principle within the audit team. It's all about building a culture of integrity and transparency. Moving on to our next question. What is the difference between test of controls TOC and test of details TOD? Ah, the classic audit dilemma. TOC is all about evaluating the effectiveness of a company's internal controls. You're checking if the controls are designed properly and working as intended. On the other hand, TOD involves examining the actual transactions and balances to verify their accuracy. Think of TOC as the safety net and TOD as the tightrope walk. Both are essential for a comprehensive audit, but they serve different purposes. Now, let's get a bit more technical. How do you perform a forensic audit to detect fund siphoning through payments to shell companies? Forensic audits are like detective work in the finance world. You start by gathering all relevant financial records and documents. Then you analyze the flow of funds, looking for unusual patterns or transactions that don't align with the company's normal operations. This includes scrutinizing payments to companies that lack a legitimate business purpose, those classic shell companies. You might also use data analytics tools to identify anomalies that could indicate fraud. It's all about piecing together the puzzle. Next, what steps are involved in a forensic audit process? Let's break it down. First, you define the scope of the audit based on the suspicions or allegations. Next, you collect evidence, which could include interviews, document reviews, and data analysis. Then, you analyze the information to identify any discrepancies or fraudulent activities. After that, you prepare a detailed report outlining your findings, which can be used in legal proceedings if necessary. Finally, you might also provide recommendations to improve internal controls to prevent future fraud. It's a thorough process, but each step is crucial for uncovering the truth. Now, let's talk about digital forensic techniques. What digital forensic techniques can be used to investigate fraudulent financial transactions? In today's tech-driven world, digital forensics is a game changer. Techniques like data mining and analysis of transaction logs can reveal patterns indicative of fraud. You might also use software to recover deleted files or analyze emails and communications for evidence of collusion. Additionally, examining the IT infrastructure can help uncover any vulnerabilities that were exploited. It's all about leveraging technology to bolster your investigation. Shifting gears a bit, what steps would you take to verify transportation charges in a manufacturing company? This is a practical question that comes up often. First, you start by re-ents the contracts to ensure accuracy. It's also essential to check the supporting documentation like delivery receipts to confirm that the services were rendered. Lastly, you might conduct a sample test of transportation charges to ensure consistency across the board. It's all about attention to detail. Now let's tackle a fun one. What are the audit procedures for auditing revenue and expenditure in a multiplex? Auditing a multiplex sounds like a movie. You'd start by understanding the revenue streams, ticket sales, concessions, and advertising. Then, you'd review the sales records and compare them against the cash receipts to ensure everything adds up. For expenditures, you'd examine the expenses related to operations like staffing and maintenance. It's crucial to verify that all expenses are legitimate and properly documented. And don't forget to assess any revenue sharing agreements with distributors. It's like putting together a blockbuster hit. What special points should be considered while auditing a bank's compliance with statutory liquidity ratio (SLR) requirements? Auditing a bank is a whole different ballgame. You'd need to ensure that the bank maintains the required percentage of liquid assets as stipulated by regulatory authorities. This involves reviewing the bank's balance sheet, analyzing its asset composition, and verifying compliance with SLR norms. Additionally, you'd assess the bank's liquidity management policies and procedures to ensure they align with regulatory expectations. It's all about keeping the bank on a solid financial footing. Now, let's talk about the scope of concurrent audits in a bank. What is the scope of concurrent audits? Concurrent audits are like a real-time checkup for banks. The scope includes evaluating the bank's transactions as they occur, ensuring compliance with regulations, and identifying any irregularities immediately. This type of audit helps in risk management and enhances the overall governance of the bank. It's a proactive approach that allows for timely interventions, making sure everything runs smoothly. Next up, what are the responsibilities of a peer reviewer in a CA firm, and what are the obligations of the practicing unit? Peer reviewers play a critical role in maintaining the quality of audits. Their responsibilities include evaluating the audit work performed by their peers, ensuring compliance with auditing standards, and providing constructive feedback. As for the obligations of the practicing unit, they must cooperate with the peer review process, provide access to necessary documentation, and implement any recommendations made by the reviewer. It's all about fostering a culture of continuous improvement. Now, let's shift our focus to internal controls. What questions would you include in a checklist for testing internal controls over cash and bank balances? This is essential for ensuring the integrity of financial reporting. You might want to ask, are there proper segregation of duties in cash handling? Is there a regular reconciliation of bank statements? How often are cash counts performed? Are there policies in place for handling discrepancies? By covering these bases, you can ensure that internal controls are robust and effective. Moving on, how would you handle policy lapses and revivals in a life insurance company during an audit? Policy lapses can be tricky. You'd start by reviewing the company's policies and procedures regarding lapses and revivals. It's crucial to understand the reasons behind any lapses. Was it due to non-payment or perhaps a failure in communication? You'd also want to check if the company followed its own procedures in reviving policies, ensuring that all necessary documentation is in place. It's all about ensuring that the company adheres to its own standards while protecting policyholders' interests. Finally, how do you determine materiality when auditing the consolidated financial statements of a company with subsidiaries? Materiality is a key concept in auditing. When auditing consolidated financial statements, you assess materiality at both the group level and the individual subsidiary level. This means considering the qualitative and quantitative aspects of financial information. You'd look at the size of the subsidiary, the nature of its operations, and its impact on the overall financial picture. It's a balancing act, ensuring that you're focusing on what truly matters for stakeholders. And there you have it. We've covered 50 essential questions that every aspiring auditor should know. I hope you found this monologue engaging, relatable, and informative. If you're preparing for an audit interview, make sure to review these questions and answers thoroughly. Remember, confidence and knowledge are your best allies in the interview room. Don't forget to like, subscribe, and hit that notification bell for more finance knowledge. Until next time, keep learning and growing in your finance journey.